Hey there, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Welcome to the show. This is the place that you come to for personal finance, investing tips, investing know how, some business talk, business strategy, and lots of other things that fall underneath those umbrellas. Today, we're talking about this continued, rapid, sudden, rip your freaking face off stock market sector rotation. Whew, that's a mouthful. Sector rotation is coming at us fast and furious. And what I mean by this is when investors who have leaned so heavily on a small handful of these giant mega cap tech stocks and tech related stocks, the FANG plus M stocks. So FANG, so Facebook, Apple, Amazon, Netflix, Google, and the M is for Microsoft. There's a few others you can throw in there, but those are the heavyweights. Those are the big ones. Investors have been leaning on the same stocks. They've become such a big portion of the overall index that they're in the S&P 500 index. By the way, you cannot invest directly into an index, but you could invest in a security or a security that tracks or mimics an index. Whew. So let's talk about the sector rotation. It is ripping the face off of a lot of investors right now. And people, maybe not you, but the investors who really move the market around, the institutional investors, I think they're a little worried because if you're trying to make your year on the same stocks that keep going up and getting out of the same stocks that keep going down, like the reopening stocks, then what's going to happen is that when your performance starts to get dragged down because other investors are rotating out of your big winners, you're starting to think, I don't want to give up these big gains. I'm not going to look so good for the year. I have to get out too and get into these same stocks. And really, yes, sometimes it is as simple as that. And that, I think, is what's going on. And I think that carries this sector rotation for quite some time. Just my opinion. There will be bumps in the road. We've had head fakes before. So let's talk about that and see what we should do, what you should do, what we should know. Because the whole thing here is what you do is up to you. But this is what puts the personal into personal finance. And to take a political term and turn it around for a pun, maybe for us, is let's make personal finance great again. Stick around. We've got some great stuff to cover. Here's the intro, and I'll see you in about 19 seconds. Okay, you and I, we are just so back here. We are back to being live, to be the boss of your money. Actually, we never left. So we do this every day, folks. Every Monday through Thursday at 4:30, I do this live show, Be the Boss of Your Money, to teach you about personal finance investing and to really, and to really give you a true view of what's happening, a bird's eye view in the stock market, what's going on with the economy, how this affects us. These are the things that we need to know. And that's what I do. I've been a financial advisor for over 30 years. I write a lot of content. One of the things I get to do is write articles for CNBC, and I'm in a lot of media outlets. So yes, humble brag, I know, but I want you to know I'm here to give you everything I know. I want to bring you value. I want to make your time worthwhile. So welcome to Be the Boss of Your Money. I see you. You are out there watching. If you have any questions, go ahead and ask me in the comments. If you're watching this in the replay, I'd like to welcome you as well. Certainly ask your question in the comments as well. And if we're not connected on LinkedIn yet, definitely connect with me there. So I don't really know where you're coming from. Are you coming from LinkedIn, YouTube, or Facebook? Because those are the places that I'm streaming this presentation to you right now. So let's talk a little bit about sector rotation, what's working. So when we have sector rotation, it means investors are getting out of something. Investors are, let me start that again. When we have sector rotation, it means that investors are selling something and moving the money into something else. It doesn't mean they're taking the money out of the stock market. It means they're just selling some stocks that are winners, and maybe they're, rebalancing. I think that's a good way to put it. They're rebalancing into sectors that haven't performed. So we have seen what I think was the greatest sector rotation of all time. Starting last March with the lockdowns in the economy, what we had were the government induced and statewide shutdowns of the economy, to fight COVID. And you saw the economically sensitive stocks, the reopening stocks, those have been crushed. And the work from home stocks, like the FANG plus M stocks that we spoke about at the top of the show, Facebook, Apple, Amazon, Netflix, Google, Microsoft. We talk about these stocks all the time. I'm sick of talking about them, but we have to talk about them because they're such big companies. These stocks have seen all this money go into them, and these stocks have risen to $1 trillion. We even saw Apple hit a $2 trillion valuation. It's not just those stocks that went up as far as tech and tech related, but those are the main ones because they're the biggest ones. But now we're seeing something happen because of the announcement that we received on Monday from a company called Pfizer, one of the major American pharmaceutical companies. They have a COVID vaccine that they said is 90% effective. Keep in mind, the CDC was hoping for something 50 to 60% effective. So 90% effective. I mean, this is a game changer. This gets the economy up and running. It's going to take a long time for everybody to become vaccinated. And there is always the chance that the FDA does not give this vaccine its final blessing. We've had head fakes before where we've seen sector rotation out of the tech stocks, work from home stocks into industrials, financials, materials. Okay, you get the point. Consumer discretionary, energy stocks. So we're going to go over this today. I'm going to give you specific examples of the stocks that are in these sectors, and I'm going to really leave you with what I hope is the feeling that you need to have both. I don't think you should just say, I'm getting rid of all my work from home tech stocks and I'm going to just sell everything and go into only the economically sensitive stocks that do well when the economy reopens. So, and there's also another place where money's coming out of, and that's the bond market. Do you know that the 10-year treasury, I know this sounds like ridiculously low, but the 10-year treasury is just about back up to its level when the pandemic first started, back to almost 1% last March. So interest rates go up, which means bond prices are going down. So it's another place that money's being pulled from. It's like money is being pulled from, we're pulling the money and we're pushing it in to those industrial, economically sensitive financials, energy kinds of stocks. So let's take a look. We'll do a quick little screen share. We'll tell you what to look for. We'll give you the signs. I'll sprinkle in some perspective that you need to make you a better investor, better with your moolah. Okay, see the Dow is up 262 points on top of yesterday's 800-point gain. Now, I know a lot of people are saying, holy beep. Okay, holy cow, the market went up so much. I should be making all this money. I missed it. I can't believe it. Let me explain something. Yesterday, I think the S&P was off a little. Yesterday, it was either up like a fraction of a point or up or down a fraction, but it was basically just about flat. The Nasdaq was down yesterday. Yes, the S&P was down yesterday. And the Nasdaq was down yesterday, and they're both down today. So most people go by the S&P 500. Most investment funds, products are benchmarked against the S&P 500. I gave you my index disclaimer already, so I'll spare you from that one again. But that's not going up. So don't think well, how come, I should be making all this money? No, actually, I would say most portfolios, if they're benchmarked to the S&P 500, are probably not doing so great. It's not like everybody's making a ton of money. Oh, the Dow went up 800. Because when you hear the Dow went up 800, you'd expect all the other major benchmarks to go up, but they haven't. So right now, it's the Dow Jones going up and the Russell 2000 small cap index. That's this one over here, the Russell 2K. Okay. The Russell 2K is a small cap stock index. Small caps do well when the economy is perceived to be improving or expected to improve. The reason for that is because small caps get most of their revenues sourced domestically, so they're more sensitive to the U.S. economy. The Dow Jones, the Dow Jones Industrial Average is not really an industrial average. It's more like an American big cap company average. But we'll take a look at a substitute for the industrials to give you a better idea of how things went. So, but that's why the Dow and the Russell 2000 went up, but the S&P 500 and Nasdaq continue to lose some air. All right, because these two middle indexes here, the S&P and Nasdaq, are just so heavily skewed toward technology. 10-year yield, treasury yield hovers near its highest level since March. We just went over that, about 0.9, I think 95, 96. Too bad Congress didn't push out a big stimulus about a month and a half ago when it was 0.66, because now the interest rate cost of the U.S. massive borrowing is going to start to go up on new bond issues. All right, but let's take a look. These are examples of industrial companies, and industrials did very well today. Boeing leading the pack, up 5% today. I think it was up like 13% yesterday. Plus, there's expectations that sometime in a couple of weeks, the FAA will recertify the new Boeing Max 700 series, which is just a game changer. Don't forget, Boeing about a year ago was a $400 and some odd stock. Okay. Korn Ferry, employment company, headhunting firm, Wabash National, Northrop Grumman, Granger for the people who get things done, 3M, Textron makes aircraft products, Bell Helicopters, military products, and apparently they own Easy Go golf carts as well, and greenskeeping products for golf courses. Go figure. Honeywell, Cummins engines. But you see what I mean? Southwest Airlines, John Deere, Lockheed Martin. Do you see what I mean? United Rentals, Emerson. I could keep going. These are examples of industrials. These are the stocks that are working now. Consumer discretion. So energy, consumer discretion, economically sensitive. Ulta Beauty. You know, they're doing a deal now. They're going to open up like stores within stores of Target, which, you know, how many thousands of Target stores are there, and how much traffic do they get? Now, Ulta will be opening up their own shops inside Target. Incredible. GM, economically sensitive. Okay. But these are consumer discretionary companies, or Harley Davidson, Hog, Capri Holdings owns Michael Kors. CVS is a little bit of both. We could skip over that one. But Discovery Communications, TJX, Ford. I know what you're thinking, well, how could Ford be consumer discretionary? It's considered consumer discretionary. Dick's Sporting Goods is doing well. Kohl's, Macy's even. Dunkin' is 106. Listen, that stock was, you know, hanging around in the 30s for 40s for a long time. Their company is going private, by the way. They're being taken over by the company that owns Tim Hortons. Okay. So that's about it for Dunkin'. I would, you know, now that they've received a takeover bid at about this price, don't think like, oh, I should go buy Dunkin'. It's pretty much a done deal. That stock is pretty much topped out unless somebody wants to pay more for the company. McDonald's, Disney's off a little bit, but Disney, Activision, Disney's been on a roll for a while, but Disney and Activision, that's ATVI, they backed off a little bit because those stocks were kind of considered work from home stocks. You know, Disney Plus and Activision, Blizzard, they make a lot of really cool video games. So maybe if people could go out now, maybe they'll play less video games. So let's keep going. We're flying through this, folks. You want to talk about, material stocks is another sector that's economically sensitive. Vulcan Materials, they basically crush rock into gravel to build roads. Martin Marietta, MLM, Martin Marietta Materials. It's not multi-level marketing, folks. U.S. Steel was off a little bit, but it's bounced off a lot off its old, you know, if it's low. Freeport McMoran has been doing well. Nucor Steel up $1. But you see this economically sensitive stocks. Gold up a little bit. But let's take a look at some stocks. DuPont has been doing very well. And although you see Dow, here's Dow down here, up $1.34. I mean, Dow is just in the 30s recently, but you know, it's a materials company, major chemical company. So I'm giving you examples of the kind of stocks that are economically sensitive that would do well in a sector rotation out of tech into economically sensitive stocks. Okay. Energy. If you look at energy, let's go from the best to the worst. Conoco up 6%, Royal Dutch, Kinder Morgan. But you see that? CVX is Chevron up over 4%. Hess. These are examples of big energy companies. And we have the financials. Listen, Berkshire Hathaway, KeyBank, IAT. I've been following this forever. IAT, see this? It's regional banks. By the way, folks, if you have any questions out there, hit me up in the comments. Visa, U.S. Bancorp. By the way, J.P. Morgan, Wells Fargo, Bank of America, they were off a tiny bit today, but these stocks had huge rallies yesterday. So the fact that they backed off a little bit doesn't really concern me. And lastly, we have the FANG stocks. Listen, Facebook down, Apple down a little bit, but Amazon's off like over $300 in just the last 2 days. Netflix is up a touch, Google down, Microsoft down. So you see where the money's coming out of it. You see the red stocks coming out of these red stocks going to the green stocks. So I'm not making this like a red versus blue, okay? Red wave, blue wave. It's really red versus green. But then we get into red and green. We get into Christmas time. And can you believe it? Christmas time is like, it's like right around the corner. I think we've got like, somebody tallied it up, like what, 36 more or 38 more business days left in the year. And like Thanksgiving week is kind of shot. Christmas week is shot. So there's really not a lot of time to get things done this year. I'm going to stop sharing the screen right now. We're just about done, folks. I want to thank you very much for joining me. So that's the deal. Will this sector rotation continue? I think the best part, the easy money part, has probably been made. But over the intermediate and longer term, I wouldn't be surprised if it continues because the economy is opening up, because it looks like we've got a real vaccine here, folks. Our hopes could be dashed. So caveat emptor, right? I said that right. So we've had head fakes before, but this looks very real, as all the other head fakes looked also. But it's not just Pfizer. Eli Lilly came out with some kind of new drug similar to Regeneron, which is, they made a drug that's very similar to the drug that President Trump received when he was hospitalized for having COVID. Governor Chris Christie, former New Jersey Governor Chris Christie, received it also, and it worked extremely well in helping them get over COVID very quickly. So we've got really good therapeutics coming out. It's going to take a while. So you still have to wear your mask. Don't get complacent. Let's bend the curve. Okay. Let's just be careful. We've got a tough winter coming up and over 100,000 new COVID positives per day. And that's probably, from what I understand, just a small amount of the potential amount of COVID that we're getting right now. So, but that's what a sector rotation looks like. Coming out of the biggest sector rotation we've ever seen into these massive techs with these $1 trillion valuations, money coming out of the, going into those tech stocks, coming out of the industrial, cyclical, materials, energy, consumer discretionary stocks. And now it's changing. So let's keep an eye out for that. But ultimately, I think you still really should own both. I don't think you need to make the decision. It's one or the other, at least with your serious money. We remain diversified, which is a strategy that we use to mitigate risk, but doesn't necessarily protect your portfolio from going down in a generally down market. So diversification is not a performance boosting strategy. Get your mind out of the gutter. But it is definitely a risk mitigation strategy. All right, that's about it. Thanks so much for watching. I will be back tomorrow at 4:30. And I hope you have a very good rest of your day, rest of your night, rest of your week. And I've got you all covered. Speak to you soon.